Dennis, a question for you. The chairman or chairwoman talked about the role that growth plays in and rapid growth in failing bank institutions. My question for you is this: what are your thoughts, pro or con, with making the rate of growth a more explicit factor in how risk-sensitive deposit insurance premiums are calculated? That is, should a fast-growing bank pay a higher rate of premium than a slow-growing bank?
Bert, you're a bigger expert on this than I am, but we both know that merely looking at a rate of growth tells you very little. It's the composition, concentration, and activities associated with the rate of growth, and it's both, you've got to look at the asset side and the liability side. And so it's the full balance sheet you have to look at and the complexity of what the particular institution is doing and how it's doing. If it's a single institution that's growing based on shopping mall funding in the Dallas area in 1989, that's very different than a financial institution growing at the same rate that's geographically diversified and product diversified. So this, as you know also, is supposed to actually be captured on, I don't know whether you want to call it the more nuanced or the more tailored supervisory side of our regulatory system. And so it already should be a material part of the regulatory architecture and the outcome of that, which is to say, you brought up a good point that I think everybody agrees with. Part of the problem is you have this cliff effect. If you all of a sudden become less well capitalized, you can't get broker deposits, boom, there goes that funding source, and then where do you get it? What do you do? My answer to that is that really says nothing about, or my view would be, that says nothing about the broker deposit rule. That said, I would say, where are the supervisors 6, 12, 18, 24 months before they're at the point where they're bang less well capitalized and the broker deposit option is not available. So I think it's much more complex than saying like yes or no, look at assets, don't look at assets. They're looked at carefully and they're calculated carefully in terms of the overall risk assessment.